Okay, guys, so let's go to Ask Scruff. Let me just flick this over and I'll fire it up. Now, this is for Cliff. Let's salute to you, Mikey. Okay, so the question bit's near the end without reading out the entire paragraph. Okay, so the essential thing is about how to downgrade, trade, and one thing and another, and sort of alleviate losses. Okay, so what I'm trying to do is minimize losses and be able to build up the account. For say a scalp, which might be 6 pips, if I do Scruffy Madness, then the small potential gain may well be totally swallowed up by the loss if I set it up with Madness behind a resistance line and then turn point price. So on some occasions I don't bother and it puts me off the trade, but then on other I find that it went to target. And then there's the ATR. As I understand, depending on the market, that price oscillates as a broad rule of thumb, to use half, 3/4. So just seeking an understanding. Okay, right. It's not as complex as what you might think. So first of all, when you're looking to set a trade up, there is a big difference between a day trade and a scalp. Okay. Now, whenever I'm looking at golden eye and things like that, it's always based on a day trade scenario. Okay. So in other words, I'm trying to get some decent meat off the bones. Now, in that case, the ATR is in place and I work on 1/3 of a third. Okay. So in order to get hold of the wave, it's 1/3 of a third. So on 90 divided by 3, that means the wave is 30. So the initial target or the baseline target would be 10. All right. Because you can catch that. Now that's 10 pips within an hour. Now, what I've also got to bear in mind is the markets do oscillate. So my maximum parameters are about half an ATR. Now, when it is like that, I'm also expecting the market to move against me into that, which would come down into, say, a position 3. Now, for those of you who are unaware of what Madness is, the guys in the squad will know exactly what it is. It's a DCA program. Now, from position 1, or position 3 rather, down to where the stop is, that should be roughly equal to where the target is going to be. So even if you started with a 10 pip target, that 50 has quite a ways to get up there. Now, what you've got to now work out is how often you hit the nail on the head. If you hit the nail on the head pretty much every time, you don't need to DCA. Whereas I can't. If I took 100 to 200 trades, a big proportion of them, the market moves against me. So therefore I need to capitalize on it. So that's the first element. Now, if it was going to be a scalp, well, that's a different animal altogether. Because a scalp of, say, 6 pips where you're looking to be in and out in a flash, Madness doesn't quite work in the same way. And this is where the questions come from. Should I be taking the trade in the first place? Well, if I think I can only get 6 pips out of it, or sort of 5 pips, I'm not looking to Madness into it. I'm looking to pretty much just go at it and get it over and done with. But I trade very small in relation to the account. So one of the reasons I don't like scalping is if you get caught on a sort of 5 pip target and you letting this thing run for 50 pips in the opposite way, it'll never work out. So you've got to be pretty much 100% certain that's going to run for you. If it isn't, then that's where the other question comes in. Is it worth it? Well, the answer is no. So you leave it alone. And I never worry about what could have been. It's one of the worst traits traders have. Oh, if only. And then you have that mentality of, well, last time I didn't take the trade, so this time I'm going to take the trade. And what does it do? That's the one that wipes you out. So what you've got to do is you're always looking at what's going on. Now, the first element is if it's trapped between two levels, it's going to hit one of them. It is, right? It has to. So your target is either the top or the bottom, depending on what your dominant direction is. And the stop is the other side of the line. Now, if the market's going to oscillate between the lines like this, which it does, you can then capitalize with that with madness. And that helps you sort out all of the questions of, can I afford it? Is it worth it? All of this. But just to go at the market and sort of put madness onto everything, no, not quite. There's a difference between, well, I often say there are 4 disciplines in trading. Position trading. Put your money in January, it's there for years. It's what the Vanguard account is, and slush fund for my trading accounts. You've got a swing trade, past 24 hours to a week, couple of weeks maybe, or even just a few days. Then you've got day trading within a 24-hour period. And then you've got scalping. Now, the difference between the scalping and the day trade is the pip count. When you're looking at a day trade, you're looking for 10, 20, 30 pips as your average of trades. When you're scalping all the time, it's 2 to 5. And the thing is, the 2 to 5 over time will catch you out. Whereas if you're going for the bigger trades, you'll find through time your account will build up. Hope that helps. Catch you soon.